Go all Roth because taxes are going to be higher in the future than they are today. This is something that a lot of people have said to me over time, and it's something that a lot of advisors think, but I don't think this is the right way to look at things. Let's take a step back and just talk about the difference between Roth and traditional accounts. With traditional accounts, you put money in, it reduces your taxable income, that money grows tax deferred, and then when you withdraw it, you pay income taxes. With Roth accounts, you put in money post-tax. You already pay tax on those dollars, that money gets to grow tax-free and it gets to be used tax-free in retirement. The average person hears this and they say, oh my gosh, why wouldn't I put every dollar in Roth? I think that the US national debt is gonna continue to go up, and the only way to fix this is to increase income taxes. And even if you think this is true, that doesn't mean that you should go all Roth today. Come 2026, tax rates are gonna go up. So what was the 37% tax bracket is now gonna be 39% tax bracket. Does that mean that you need to go all Roth today? No. And here's why. So when you pick between Roth and traditional today, you are locking in or deferring at your top marginal tax rate. So let's say you live in California, you make $2 million a year, you have the choice between the two. If you do Roth, you're choosing to pay 37% marginal for federal, and you're choosing to pay about 13.3% to state. So about 50.3%. So if you put in, $23,000, that doesn't reduce your taxable income. That money is gonna grow tax-free, and then you can use it tax-free in retirement. If you chose to put money in the traditional side, it really only ends up costing you about $11,500. Why? Because it reduced your taxable income, which means you saved that much on taxes. When you look at these two in a silo, if you did Roth and you invested all those dollars, that's better off than doing $23,000 in pre-tax, right? Because you're gonna have taxes down the line. But if you take those tax savings and you actually invest them, like all of our clients choose to do, now you actually have a real conversation here on what is best. Think about this example we're using. If you choose to defer today, then you are saving at that top marginal tax rate. Now we fast forward to the future and you withdraw this money. When you withdraw this money or you convert it to Roth, you fill up brackets, right? So a lot of my clients, they're deferring at this top bracket. They're selling a business, they're starting their retirement, they have no income. We structure their portfolio and their cash positions in ways that they're not driving up a lot of income taxes, which gives them the ability to convert through brackets. There's the 0% bracket, there's the 10% bracket, there's the 12% bracket, there's a 22% bracket, there's a 24% bracket, and so on. And so for a lot of our clients, they can convert through the 24% tax bracket. This might be $200,000, $300,000, or $400,000, depending on what else is going on. And so now they might have been able to move over all of that money at an effective rate of 16, 18, 20%. So they were deferring at this top bracket, they're withdrawing through bracket. This is exactly why everybody should not just go Roth. If you're in a really low bracket, somehow 0 or 10 or 12, Roth often makes sense, right? It's gonna be very hard to be in that low of a bracket ever again. If you're in 22 or 24, it's kind of a toss up, right? Who knows what the future looks like? If you're really young and your income's gonna be only increasing, Roth might make sense. If you're about to retire and that's the highest income you've ever really been in and you don't live off of a lot of money, then traditional might make sense. And then once you get to these 30% brackets, that's where it starts to really make sense to defer. Because we're not just looking at tax rates go up in the future, I'm gonna be in a higher marginal rate. We gotta think about marginal versus effective as we fill up brackets. So I am totally on the same page that the goal is to have as much money in Roth as possible. But the thing that people don't understand is you can get Roth money in without putting in Roth money today. The way to do that is through Roth conversions. But Roth conversions allow you to convert pre-tax money to Roth and you pay those income taxes today. If you do that, you need to pay for those taxes out of cash. Why? Because if you withhold for taxes, then it ends up counting as that 10% penalty. Basically, you can't touch retirement accounts before 59 and a half. Roth dollars, you can technically touch contributions, but if you're doing a Roth conversion, you withhold taxes, you're gonna pay a 10% penalty. You wanna plan for this out of cash that you have on hand. All Roth conversions is you get this opportunity to defer at high brackets, and then you find periods through your life where you have low income. This could be post a business sale, this could be sabbatical, it could be when one spouse stays at home, it could be early retirement. All of these create opportunities to do Roth conversions. And the other Another great time to pair these together is if you have those years plus a downtime in the market, right? If your portfolio is $1 million, it's dropped 20%, now it's 800,000, you can move over way more of your portfolio to Roth, invest it at that down period of the market, and take advantage of that growth in the Roth account. Roth conversions are one of the most powerful tools out there. For many of our clients, they're doing cash balance plans. They're maxing out solo 401ks for them and their spouse. They're really deferring $200,000, $300,000, $400,000 a year. If you have a strategy for Roth conversions where you're deferring at top brackets, converting through lower brackets, then this can be a really amazing tool. If you're somebody that isn't going to do that and you're just going to defer, you're setting yourself up for tax bombs down the line. Why? Because pre-tax accounts have what we call RMDs, just required minimum distributions. So this means, depending on your age, let's say it's 72, you have to start taking money out of these pre-tax accounts, whether you need them or not. So what ends up happening is we have all these high income earners. They get to that age, they have Social Security, they have dividends and interest and everything from their bonds, and they have plenty of money to live off of. Well, pre-tax accounts say we don't care. We're going to look at your life expectancy and you're going to be required to take money out. So for most high income individuals, if they don't do Roth conversions and they defer for years and years and years, they're setting themselves up to have all of this forced income and push themselves into really high tax brackets. This is why this strategy is so important. For high income people, it's defer, find opportunities for Roth conversions. And when you do that, you ultimately are lowering your effective tax rate. Deferring at 37, filling up and having an effective rate of 18 to 22% is really good tax planning. Think about that alpha right there, right? 37 to 20, that's a 17% tax difference. Roth conversions are one of the most powerful tools. And I totally agree that getting money in Roth accounts should be the goal. Do you need zero in pre-tax accounts? No. Having an okay amount where you have some RMDs, you can even do qualified charitable distributions and send money over there tax-free. Having money in pre-tax is still good. You just don't want to have too much. And then you, on the flip side, you also don't want to just put every dollar in Roth, because think about it. If you retire, let's say at 60 and you have 32 years to live, in all likelihood, there's going to be periods of time where taxes are actually lower. So you want to have diversification between taxable, pre-tax, and Roth. And if you're in a high income earner and you're deferring a ton, you need a great strategy on Roth conversions. It can be the difference of millions of dollars at the end of the day. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.